Hello, everyone. Art Alvarez at MortgageWorks, where we have the answers and they're on the house. Last week on our Mortgage Minute program, I told the story about a family I was working with looking to buy a home. They had very good income, no down payment. And so they asked me to help them with that scenario. What I did is I offered them some numbers based on using a CalHFA down payment assistance program. CalHFA is the California Housing Finance Agency, a state agency that provides down payment assistance to first-time homebuyers. By the way, most first-time homebuyer programs are more about down payment assistance than getting a lower rate. In any event, I presented them some numbers involving an FHA loan with a 3.5% down, and then getting a junior lien through CalHFA for that 3.5% piece, that down payment piece, so that it would be entirely covered. That junior lien would be at a 1% simple interest with no payments. It would simply get paid back later when you refinance or sell the home. In presenting that to them, I also pointed out they could actually get a second lien that would be for 2 to 3% of the price, and that could be used to cover their closing costs. So they could effectively get through CalHFA down payment and closing cost assistance to buy this home with no down payment and virtually no money out of their pocket. However, I wanted to point out to them there are some trade-offs. With this kind of structure through CalHFA, the FHA first mortgage, it's going to have a higher rate than a market rate loan. A lot of times about a 0.5% higher, which of course means a higher rate, or a higher payment. Also, it's tougher to qualify for. Your credit score can only be as low as 660. Regular FHA loans, you can have a 3.5% down payment down to a 580 score. Plus the fact the maximum debt ratio for this CalHFA structure, 45%. A market rate FHA loan, you can go to 50, sometimes as much as 55% on debt ratio and still get approved. So I wanted to make sure that I pointed out both of these options to this family so they're fully informed and aware of the pros and cons of both, in particular as to their future needs. What do I mean by that? Well, if you go the CalHFA route, whether you get that one junior lien or two, you're going to start off with no equity in the property. And again, that junior lien, or if you get both of them, they have to be paid off later when you refinance or sell the home. Well, what if rates fall in the next couple of years as expected, and you want to refi that CalHFA loan, and you've got both junior liens on there? Well, you may not have gained enough appreciation in the home value to successfully refi because you got to pay off those two junior liens. It could be an obstacle in getting the refi done. So you could be locked into that CalHFA structure for a longer period than you planned. Or what if your family grows? You first buying a starter home, then you have maybe a child, maybe a couple of children in the next 3-5 years, and you want to then sell. You need a bigger home, maybe with more bedrooms. Well, if you went the CalHFA route, you may not have achieved enough buildup in equity to get any kind of significant proceeds if you sell the home within the next several years, 3, 4, 5 years. So again, that can be an obstacle for moving up to that next home if you've got too much mortgage debt on that home through the CalHFA down payment assistance when you first purchase it. So you need to be aware of those future concerns, those future issues you want to think about and make sure you're not going to be locked into this loan longer than you want to. And then as to the FHA market rate option, yes, I do have to point out you have to solve that down payment problem through another way. Gift from a relative is very common. Borrow against your 401k. And then as to closing costs, what you do is you get a really good agent, good at negotiating an offer, and in your offer, negotiating a credit from the seller to cover some or all your closing costs. So as a consequence, if you're able to do that, again, you got to solve that down payment problem. An FHA loan market rate with maybe a seller credit toward closing costs can be overall a much better package and as to the terms versus CalHFA down payment assistance. Now again, CalHFA down payment assistance, great program. We do many of them, but you want to be fully informed of what the other options are for market rate terms, because overall, long term, that could be better for you, not only now in terms of lower rate, lower payment, easier to qualify for, but more options in the future to refinance into a lower rate or to get that home sold, get some proceeds to buy that next home that you're going to move up, get a bigger home with more bedrooms for your growing family. So it's important to know that you have both of these options, and that's my job, is to make sure you're fully informed so you're going to make the best decision. So I hope this information helps, especially for first-time home buyers Please contact me directly if you have any questions. My information is on the screen in the upper right-hand corner. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Thanks again. We will see you next time on the Mortgage Minute. Bye for now.